Everyone was told the Las Vegas housing slowdown was a manageable dip. Then the numbers turned impossible to ignore. Home values have fallen to $425,260, according to Zillow. Median prices dropped another 2.2% by October, and sales volume just posted its sharpest slide since the last crash. Beneath the city's neon glow, a market once defined by frenzy now faces a reality even the experts underestimated. But how did the iconic boomtown go from a hot streak to free fall? And who stands to lose the most as the true scale unfolds? Las Vegas home prices no longer tell a story of endless gains. The latest Zillow estimate puts the typical home value at $425,260. The city that once topped national growth charts now faces a year-over-year decline of about 1.2%. Redfin's October data draws the line even sharper, with the median sale price dropping to $440,000, down 2.2% from the same month last year. They are the new baseline confirmed by two of the most widely tracked real estate data sources in the country. For years, Las Vegas homes seemed immune to gravity. From 2020 through 2022, sellers watched property values soar month after month, with bidding wars and offers far above asking the norm. That momentum has stalled. Now the market posts back-to-back declines, and the numbers refuse to bounce. The price per square foot has also slipped, settling between $259 and $262 per square foot across the metro. For buyers who stretched in 2022 hoping for future appreciation, these shifts are not just statistics, they are a warning. The city's median price, which once hovered near $480,000 at the start of 2025, has shed nearly $40,000 in less than a year. This is no seasonal fluctuation. Each fresh data release reinforces the same message: the market's direction has changed. The headlines may talk about a slowdown, but the numbers show something deeper. The boom has not just cooled, it has started to unwind. Sellers who once counted on double-digit gains now face a reality where holding steady is the best-case scenario. As prices slip, the sense of urgency among buyers is fading. The days of quick flips and instant equity are gone. Instead, every new sale at a lower price sets a precedent. Buyers are stepping away from the table in Las Vegas. In June 2025, only 1,946 single-family homes changed hands, a 7% drop from the same month last year. This is not just a blip. Every month, the number of closed deals continues to shrink, even as more homes pile up on the market. The slowdown is visible in the rhythm of the market itself. Where homes once vanished in days, listings now linger. The average property spends 42 days waiting for a buyer, up a staggering 42% from a year before. The drop in sales volume is even sharper in some corners of the market. Condos and townhomes especially have seen their transaction counts fall off faster than single-family homes, a sign that the demand erosion is broad-based, not isolated to one segment. Nearly 15% of pending contracts in June 2025 fell through before closing, the highest cancellation rate for that month since records began in 2017. Buyers are backing out during inspections, finding better deals elsewhere, or simply losing confidence as the economic picture grows cloudier. Fewer buyers are willing to commit, and those who do are taking their time, negotiating harder, and walking away more often. For every home that sells, more are left waiting, and the backlog is growing. This contraction in demand is the first domino. Before inventory swells, before price cuts spread across neighborhoods, it is the buyers who quietly step back, leaving sellers with little choice but to wait, adjust, or withdraw altogether. In June 2025, active single-family home listings soared by 77.6% compared to the same time last year, the sharpest jump among major U.S. cities. By September, the market held 7,502 active listings, and that number climbed to 7,538 by October. These are not just numbers on a spreadsheet. They represent thousands of homeowners waiting, often in vain, for a serious offer. The backlog is staggering. Nearly 7,000 homes sat on the market in June 2025 without a single offer. By the fall, that figure had barely budged, with 7,502 single-family houses still waiting for buyers. For every property that finds a new owner, more join the queue, swelling the total supply. The market is now flooded with options, giving buyers more choice than at any point since before the pandemic. Months of supply, a key measure of market health, has pushed past 4.5 months. In a balanced market, that number sits closer to 5 or 6. Las Vegas is now approaching that threshold, after years when inventory was so tight that bidding wars broke out over nearly every listing. For sellers, the reality is unavoidable. The odds of a quick sale have plummeted. For buyers, the choices are overwhelming. This glut of unsold homes is the new backdrop, setting the stage for what comes next as sellers confront the pressure to cut prices and stand out in a crowded field. Price cuts have become the new language of Las Vegas real estate. Nearly 40% of all active listings have slashed their asking prices, according to Housing Wire's latest analysis. Sellers who once dreamed of bidding wars are now forced to chase the market downward, trimming expectations with every week their home sits unsold. The wave is not limited to a single price range or neighborhood. It sweeps across gated communities, starter homes, even condos on the Strip. The numbers tell the story. In October 2025, almost 2 out of every 5 homes on the market had already been discounted at least once. For many sellers, the first cut is not the last. Listings that linger often see multiple reductions, each one a step closer to reality. The pressure to stand out is fierce. With so many options available, buyers can afford to wait, compare, and negotiate harder than ever before. Sellers, meanwhile, watch as their competition drops prices and wonder how low they will have to go to attract an offer. This is not just a handful of desperate homeowners. It is a citywide pattern. From high-rise condos to suburban family homes, the price cut wave signals a market under strain. The longer a property remains unsold, the more likely it is to join the ranks of discounted listings. In Las Vegas, the question is not whether a seller will cut their price. The question is how soon and by how much. Condo and townhome owners in Las Vegas are facing a stark reality. The number of these units sitting on the market without a single offer has soared, up 88% compared to last year. That is not just a statistic. It is a sign of where the pain is deepest. In June, over 2,600 condos and townhomes were listed with 0 buyer interest. And by October, that figure climbed even higher. The hardest hit areas cluster around the Strip and adjacent zip codes, where high-rise towers once marketed as prime investment opportunities now stand with rows of unsold units. This glut is not limited to luxury penthouses. Entry-level condos, mid-rise buildings, and townhome developments across the valley are all feeling the strain. Sales in this segment have dropped faster than in single-family homes, and the backlog keeps growing. For investors who bought during the boom, expecting steady rental income or quick appreciation, the math has changed. Many are now competing to offload properties in buildings where dozens of similar units are also for sale, most offering price reductions or extra incentives just to attract a showing. The financial math is no longer the same. The data forms a pattern. The higher the density, the steeper the decline. Investor-owned units and retiree flips are flooding the market, driving up supply and erasing any sense of scarcity. Heat maps of unsold inventory light up around high-rise corridors and dense urban zip codes, painting a clear picture of concentrated stress. In these pockets, the days of easy profits are over. The leverage has shifted, and buyers, if they are interested at all, hold all the cards. A family who bought their first home in Summerlin in early 2023 now faces a reality they never planned for. At closing, their 3-bedroom house appraised at $510,000. By late 2025, the most recent comparable sales in their neighborhood show values closer to $470,000. That is a $40,000 drop, and their equity has effectively vanished. The couple had put just 10% down, expecting to build wealth as prices climbed. Now their mortgage balance exceeds what the house would fetch if they tried to sell. For them, moving is not just complicated, it could mean writing a check to walk away. They are not alone. County records show more than 1,000 notices of default filed in the first half of 2025, up nearly a third from last year. Each one represents an owner unable to keep up with payments or unwilling to hold a losing hand. A small landlord with 4 rental condos near the Strip faces a different kind of stress. 2 units have sat vacant for months, even after dropping rents by $200 and offering the first month free. The rent rolls tell the story. Where once every lease renewal meant a bump in income, now it is a negotiation just to keep tenants in place. In July, he accepted a 6-month lease at 10% below last year's rate, just to avoid another empty unit. His mortgage payments have not changed, but his rental income has shrunk. Recent MLS listings for his building show a half-dozen similar condos for sale, most with price cuts and days on market ticking upward. He has started to consider selling, but with prices down nearly 9% from last year's peak, the math does not work. For landlords like him, the promise of easy cash flow has turned into a balancing act of concessions and patience. A would-be buyer, pre-approved and ready to purchase a townhome in Henderson, decided to walk away after the inspection. The dashboard of market stats on her phone told the story. Inventory still rising, price reductions spreading, and days on market climbing month after month. The unit she nearly bought had already been relisted twice with price cuts totaling $35,000. After seeing comparable sales still trending down, she withdrew her offer, forfeiting her inspection fee but preserving her flexibility. She is now waiting, watching the numbers, and weighing whether to re-enter the market as conditions continue to shift. In Las Vegas, the stakes are no longer abstract. For homeowners, landlords, and buyers, every decision is shaped by numbers that refuse to reassure and by a market that is rewriting the rules in real time. Every housing cycle has its warning lights. In Las Vegas, those signals are no longer subtle. They are flashing on every dashboard. For anyone trying to make sense of where the market is headed, a handful of metrics now matter more than ever. The first is months of supply. When this number pushes above 4, buyers start to dictate the terms. At 5 or 6 months, the market is balanced. But if months of supply climbs past 6, history shows price drops accelerate, and sellers lose most of their leverage. Right now, Las Vegas sits above 4.5 months of supply, closing in on a danger zone that has not been seen since before the pandemic run-up. Inventory is the next gauge to watch. The city crossed 7,500 active listings in October, and analysts warn that if the number passes 8,000, the backlog could become unmanageable. That is the level where past downturns have tipped from slow correction to outright slide. For buyers, more inventory means more choice and negotiating power. For sellers, it is a race to stand out before the market turns even colder. Price cut percentage tells its own story. When more than half of active listings are seeing reductions, it is a sign that sellers are chasing the market downward. If that figure rises above 75%, distressed selling tends to spread, and buyers become even more cautious, waiting for the next round of cuts. Sale-to-list ratio is another critical signal. When homes start closing at 98% or less of their asking price, the gap between what sellers want and what buyers are willing to pay becomes impossible to ignore. It is a clear indicator that concessions are now the norm, not the exception. Days on market rounds out the picture. 42 days is already a sharp jump from last year, but if properties start sitting for 60 days or more, it means buyers are in no rush and sellers are left with few options but to cut prices or withdraw. Mortgage rates, too, are a wild card. If rates fall below 6%, demand could rebound. If they climb above 7.5%, the pool of qualified buyers shrinks even further, deepening the slowdown. Out-of-state buyer activity is another pulse check. If the flow slows or reverses, local sellers lose a key source of demand. For anyone navigating this market, whether you are thinking of buying, selling, or just watching from the sidelines, these are the gauges that matter. They are not just numbers, they are early warnings and sometimes the last chance to act before the next phase begins. In Las Vegas, reading the dashboard can mean the difference between catching a falling knife and making a move at just the right time. Right now, nearly 40% of Las Vegas homes face price cuts, and inventory keeps rising. As these numbers climb, more owners and investors confront hard choices that ripple beyond city limits. Housing markets are not just local, they are signals. Vegas shows what happens when hype outruns fundamentals, and the consequences land in real time. The next move is not just about the Strip, it is about who learns before repeating the cycle. Share your thoughts below.